If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall McLeod. Let's go, baby. All right, welcome back to the show. It's great to have you on again today. This week, we are talking with an operator in the multifamily space. As I've always promised, I want to bring operators on so that you can see what actually is happening behind the scenes on multifamily acquisitions and transactions and different asset classes as well. So we wanted to sprinkle in an interview with Kenneth Sumners of Sumners Capital. He is, like I said, an operator in this space. He's in the San Antonio market. So I know Kenneth well, and it's been great to see his business grow. He recently just quit his W-2 job so that he could get into real estate full time, literally a month or two ago. So it is great to see how he's evolved and some of the unique challenges that he's had making that shift from W-2 and some of the benefits, obviously, that he's gotten from doing that. And then the challenges from buying multifamily in the last 3 years. And so we talk about that a little bit, about some of his properties in a specific transaction. But overall, Kenneth he's a good friend, and I'm glad that he is in this business full time. He's in San Antonio, so I get to see him on a regular basis in a lot of the groups that we're in, and I get to learn from him as well. So you're going to get a lot from this episode. If you're not investing in commercial or apartments or any kind of income producing properties, pay attention, listen, because you're missing out on some tax benefits and some strategies that you could be getting if you were investing passively in these deals, or if you actually want to go out and start doing these deals. This is the whole reason I started the show, was to teach how to do what Kenneth and I are doing. So, or to get you to be able to learn how to invest in these deals passively. So yeah, let's dive right in. And as always, if you're getting something from the show, if you're getting some value, please go on wherever you're listening to the podcast or YouTube, whatever it is. Rate and review the show. It helps us out a lot. And without any further delay, let's go. Let's jump in and talk to Kenneth. All right, Kenneth, welcome to the show, man. It's great to have you on. I know you and I know each other because of a group we're in San Antonio here. And so we might touch on that in a minute. But I wanted to ask you, I know that you just recently retired, right? You quit your W-2. So I wanted to say congrats first and foremost on making that shift. And I just wanted to see if you could maybe walk us through the decision-making process you had to go through in order to make that jump. Kind of curious.
Yeah, sure. Thanks for having me on, Randall. Appreciate it. So yeah, the leap from, full-time W-2 into full-time real estate was a big transition for me, as you can imagine. So I've been doing passive investing for a few years before I got into the active side of things. I started buying my own properties with the help of syndications and other passive investors jumping in. So I had been building that up and I have 3 properties that I'm managing, and the time commitment on that was starting to grow quite a bit and responsibilities were growing. And I'm one to, my W-2 was, I was a manager of a network engineering division of a company. And that was important to me. I liked the people I worked with. I liked the projects that we were on. But the time commitment came to a head where my responsibilities were growing in both areas, and I had to choose. And I knew that my long-term strategy was real estate. So that was kind of the decision point. At some point when the scheduling conflicts got to where it just wasn't possible to do both, made the leap, and I'm doing full time. So it is funny that, I was doing the 8 to 5 kind of gig for 17 years. And now my days are much more open and flexible. And that's kind of a scary thing in a lot of ways, because you don't know what you should, making sure I'm focusing on the right things for my business.
Yeah. All right, man. Well, we're going to talk about that. So a couple things in there. One, it sounds like it was more of a time issue, more so than like the monetary, like, I guess, income has been fully replaced. Was that part of your decision-making process? Or was it like, I know that real estate's where I'm going, and even though I may not have fully replaced my income, I will soon enough or something? How did that weigh into it or factor into it?
Sure. Yeah. So, I mean, I've got a family to support as well. My wife does work full time. So that's helpful for me financially, or for our family. It's helpful. But yeah, I was able to, in the first year of moving over to the active side of things, essentially replace my income from that of a career building up to it. And then my first year in real estate, I'm able to, replace my entire income. So the writing was on the wall that financially, real estate was the way financially to move forward, right? And so, yes, I there's a little bit of residual income that comes in for asset management. It's not a lot, but it kind of pays for the business expenses, things like that. And then and the acquisition fees at the beginning, when you become active, that's part of the process. Is once you close a deal, you get you tend to charge a fee to kind of pay for the acquisition process. It's a fair amount of work, of course. So that helped me to replace that kind of base income. The asset management fees, kind of ongoing fees, helped me throughout the process and essentially paying for the company for the business expenses of running these kind of things. And the thought is down the line, once we sell these properties, the equity that I've been able to structure for these, once we sell the property, the equity split is such that that's where really everybody makes their money, including the passive investors, in a big way. So that's the 4 or 5 year kind of goal you got to eat. So just kind of continuing to find ways to make it through this period.
All right. So I wanted to ask you on, you mentioned like the 4 or 5 year like timeline you're kind of thinking about. Really, that was the same sort of shift for me. Instead of doing these short, quick hit sort of deals where I was flipping houses and that sort of thing and making chunks of money, to more of like a long term. I'm gonna be in this thing for the long haul. I want to hold things. I want cash flow like nonstop. And so one thing I struggle with when I either go to seminars or listen to a lot of syndicators at times talk about, there's it's not a conflict of interest, but it's almost like when you are investing for like a certain return, like an AAR or a certain IRR return profile, your types of acquisitions are going to be different than if you were not IRR sensitive. Does that make sense? So do you
Sure.
ever look at deals now? And I mean, this market is completely different than it was a couple of years ago, but do you look at deals with like a 10-year hold vision, or are you going to exit in 3 to 5 to 7 years now, like maybe 7 years in this time, and cash flows are struggling a bit. And so it's really, like you said, you're holding these properties for the equity growth in the long term. Is that kind of the strategy?
Yeah, that's a great question. And it kind of comes down to investor expectations, right? So my thought is, if I'm trying to get passive investors to invest in a deal, it has to be attractive, right? And so if I can come to them with a proposition that says we're going to hold for 50 years and you're going to get a 2% return, and I can attract capital, great. We can do that all day long. A lot of times that doesn't attract capital, right? That's not you can find a better investment. So the thought is, let's be the best investment for the risk profile that we're doing. The risk adjusted returns is what we're after. And so we're trying to be, just top notch on that. So if I'm going to risk passive investor income in it, I've got to know that the passive investors will be there to fund that deal and help fund the deal, right? So I'm still looking at it similar to how we did even 2 years ago in a better market. And because I know that investors probably haven't from what it was before in terms of the preferred return, the average annual return, or AAR or IRR metrics. And so if those metrics haven't been explained, that that deals aren't meeting some of the 2 year ago kind of marks, then it's going to be hard to expect them to jump into a passive investment, even though right now a lot of the deals are that I'm seeing are on sale. We're seeing a depressed market essentially. And it's kind of the buy the dip type thing, right? So this is a good time to buy, but unfortunately the cash flows that we're seeing in underwriting don't support the same model that we were before in terms of the distributions on a quarterly or monthly basis, right? Then they're going to say, hey, I'm not interested in the deal. In terms of the hold time as well, the 5 to 7 year kind of mark, a lot of times still investors do want to exit their, and get some kind of return out of it versus a cash flow play that might be a much longer term, 10, 15 year kind of play. I think they're still wanting to date these people, operators like me, they don't want to go into a 15-year relationship. They'd rather go into a 3 to 5 year, investment and say, hey, let's get it out and then maybe do it again. Right. So I think when you're building up as an active investor or you're talking to a newer operator, that I think you're probably going to see shorter holds typically than maybe a seasoned investor has been doing it 20 years. They might have some offerings for longer term plays because of the investor base is like, hey, I don't want to keep turning this money over. I'd rather just, invest with you and your program and just hold it for however long it takes, assuming that deal can cash flow. But a lot of these deals do require some capital injection, right? So they're, when you hold them for 5 years, they're ripe for the next investor to come in and add new capital to it. And when you go and you're trying to just survive off of operational capital for all your repairs, the return metrics start to reduce. Now, the returns are still okay, but the cash flow, you're living off the cash flow essentially instead of investor capital, if that makes sense.
Yeah, it does. Yeah, man, great response. It's very, very good response. I wanted to ask you something in there about you mentioned you're still looking at the same things in the same type of way. So, but have you considered or are you changing your actual offerings? Like, I don't know if you're doing 506Bs and that sort of thing, but if you can't talk about them, no worries. But hypothetically, are you changing? If it was a 7-pref 70-30 split, are you considering changing those going forward because it's a different economic cycle, or are you sticking with it and your investors like that sort of thing?
Yeah, and again, good question. It's a matter of investor expectations. Again, it kind of keeps coming down to that.
Yep.
And at this point, that's the investor expectation. So it would be more difficult to change, especially knowing that I do believe that this cycle is short-lived, right? We're in this dip, and hopefully, soon we're going to start seeing the rise again. So we're recording this kind of mid 2023, and we're still kind of in the midst of it. There's kind of a looming potential recession coming. What that might look like, we're not sure, but how fast will this rebound is everybody's question. And I get different responses from industry professionals that track this on a daily basis.
For sure.
It's all over the map. So we just don't know what's happening. But my thought is the business model that I've done in the past has been tried and true. And that's really been the model that I think has worked over the past 10 years. So now looking forward 10 years, I want to stay in that pattern. And I think we can still find deals that work and fit that same mold today, even in this time. There are fewer and far between, and they might be distressed, but the thought is still having that same kind of return metrics are happening. But I have talked to investors and say, hey, if I brought you something that still had that same average annual return, but maybe we don't have the cash flow to back up the pref and maybe don't have any distributions, would you still be interested? And a lot of people still want distributions. So that's still important, even though it's kind of a small sliver each quarter or each month that might be coming in versus the side at the end. It's still important to investors that they see that and think that sometimes correlates in somebody's mind to the deal still being a good deal, right?
Yeah.
Even though that might not necessarily be the case.
Yeah, I can see that. And it's like another touch point that they see validity for the deal, like you said. I mean, that's kind of some of the guys that I've talked to, I've seen a shift. Some have always operated with like just a straight 80-20 split, right? Cash flows come in, whatever it is, it's 80-20. There's no pref. It's just or like an 85-15 or something like that. So I just didn't know if you had seen some of that in the marketplace, or if you would consider doing something like that and had that conversation with some investors to get their feedback for that type of their appetite for that offering. We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline's currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com. So, okay, well, let's go down there. You mentioned a couple other things that I keyed in on, and you mentioned that it's kind of eating into your time, right? And so like the allure for real estate for a lot of people is like, hey, I'm just going to invest and, I'm going to have these passive, I'm going to own this property and this money's going to just come in. And the way you describe it is like, well, it takes a lot more time than you think to actually run one of these large deals, even if I have third party property management. So can you speak to that just a little bit? Like what is time consuming once you own and operate a 100 plus unit, multifamily deal?
So time commitment, if all goes well, then I think the holy grail is to passively invest and just have mailbox money, right? And that's my ultimate goal to get to, and that's that's my goals. On the active side, though, there is some time management that you need to go through, and where asset management in general isn't terribly time consuming. We take a couple, I take the asset management calls for each of the properties once a week, but there's also, of course, administrative things that are happening and all that. But a lot of it is mind share. When I left the W-2, it was amazing. So, I was really surprised when I left my W-2 about how much mind share there was being taken up by that job. And how much you really need for the real estate side. So when I was able to shed that, it allowed me a lot more, again, mind share for problem solving and administrative thought and really motivation, right? Because a lot of what we do is grueling and somewhat tedious in a lot of ways. And so, when you don't have the motivation to get up and get in front of your computer and try to do something that's going to affect the next 5 years of your life, but it doesn't affect tomorrow, you need some motivation to do that stuff and wake up and do that on a daily basis. So where your W-2, it's like if you don't do that thing today, it could affect you tomorrow, right? Yeah. And so being able to focus more on long-term strategy was really just eye-opening and just freeing for me to get to focus on that.
How do you because that's a great point. Like I cannot stress that enough. It's this investor mindset. It's an entrepreneur mindset of putting in the work now, knowing that it's going to pay off or hoping it's going to pay off. It's like a bottle of bourbon. I was talking to my buddy the other day about bourbon. They make it and then you have to wait years and years. And then did it make the trip? Is it good? So it's kind of like that. So how do you slow yourself down now to make those strategic decisions?
Good point. So yeah, slowing yourself down, that's a good way to look at it. So I'm not great at goal setting. Sometimes have the 5-year or 10-year goals, but I think like a 10-year goal for me is almost useless. Like that, what's actionable about that is tough. But so I try to break my goals down a lot sooner. In most, maybe a year. Like, where do I want to be in a year? Because I think things change too quickly in our environment to try to assume that whatever our goal is today is applicable in 3 years or something. So, but that's just me. I think a lot of people work well on goals, but goals are all about motivation. And I think my motivation for the long term is there. So now it's a matter of the steps to get there. And so finding out what are the interim steps, who do I need to be, meeting and working with. A lot of my business is connecting with not only passive investors, but connecting with other potential active investors that might, bring in investors to the project, right? Because we mostly do 506B offerings, which for those that don't know is the SEC exemption that your investors need to have a previous and substantive relationship with the investor and the operator, right? So that needs to exist before the offering is presented. And so with that, we need to make sure that our goals are aligned between me and the investor, or me and the partner and the investor. before anything happens. So we need to meet those people before we find the deal. And so that's a big part of what, the kind of the connections that I'm trying to make as well right now.
Yeah. Yeah. So, and you alluded to this a minute ago too. I had to put it down, your daily activities. So you're like, I ain't got no job, no boss. It's me. You're rolling around in your skivvies all morning. So what do you do now? Like, how do you plan your days?
Yeah.
And like, I ask a lot of people, like what your KPIs are. So key performance indicators. And so in like my business, I've got a whole sheet for Ridgeline, like all the things that I need to be doing, how many people I need to talk to on an ongoing basis, that sort of thing. So like, what are your KPIs now that you're on your own?
It's, since I'm still a little new to doing this full time. Before it was almost survival. I did everything I could whenever I could and just kind of drive towards what I thought was the horizon. Right. And so that is something that I'm working on. Like, what are my KPIs? Yeah. That's one of my tasks is identifying those things. What are the things I need to do to get me to the Holy Land, if you will? So my daily, my day-to-day activities are completely different from one day to the next. And I think it's a lot based on my motivation for that day. So some days I'm very, I'm effective in what I'm doing. I can get a lot done in those days and connect with some people. But a lot of what I'm trying to do right now is network and try to meet more and more people to try to work on, on the business with. So I'm able to take in, on the more, I guess, active side of things, not the networking side, but the actual work side. I'm able to take an offering pretty quickly from a broker, analyze it, and see if that's going to meet the needs at various levels of that process. So early on, you do a quick analysis and see, hey, is this even in my buy box? And you might go tour the property and start bringing in, some of those vendors and third-party relationships to try to figure out how that works. So if that comes in, that throws off your whole day. I've got to focus on that, and I want to act quickly on it, right? Yeah. Where I might have something scheduled, but it's less priority. So time blocking is a big thing that I try to do, and have things that are recurring or maybe one-off things that are going on. Put that in my calendar, so it's like a personal assistant telling me what I need to be doing at any given time. And if I have big blocks between tasks or things I need to do, I got to enjoy this time a little bit too. I think, especially right after working for 17 years, I know that's not forever, but maybe I'll go hit a golf ball. Maybe I'll go clean the dishes or something, right? Do something that can help my personal life, either, entertaining activities or something that needs to be done around the house. But it's, I do have that freedom now. So when I'm not terribly motivated on the real estate side of life, maybe I do something different today. So then tomorrow I know I can hit real estate hard. So day-to-day activities change quite a bit. Sure. And I don't have great KPIs to track at this point, but most of it's around how many people I want to meet on a monthly basis,
Yeah. Yeah. And that's one of the things. Like we had a consultant come in when we were doing the single family stuff, and we were implementing traction. And so they came in, they were talking to us. Yeah. And like one of the things that keyed in with me that always sticks with me now, it's like every person, like right now you are, you have marketing. I know kind of your structure and your setup of what you got, but right now you live, if I looked at your org chart, it's like Kenneth is everywhere, right? Yeah. And so one of the big things, that's the same way I'm structured, right? But you have third parties that come in, they help, they do certain things. But where I'm going with that is what the implementers told us, and the way I look at it now is like, what is the money ball, right? That's the analogy. If you've seen the movie and watched, it was like, okay, what is each position's money ball? And that's all that needs to be reported on. If it should be one activity, right? So I'm always curious. I always ask people that, because I feel like I have, 6,000 activities that need to be done. And, and that's why, again, I'm like, how do you slow down to like take this step back and be like, okay, the 10-year, it may be just like a vision. It's not like a goal, but it's like, this is where I'm going. This is why I did this, so today I need to work on X, Y, and Z. But yeah, man, do the dishes. enjoy.
We're
I take ordinary people. Granted. What's that, man?
we're all ordinary people, you know,
Yeah.
we're just living our lives and doing regular stuff. But just, the focus is different. And I think that's what it's about, is priorities, right? How do you set your priorities? And then, right now I've had to grow so efficiently in what I'm doing. Most of the things that I build, I either don't do or I build efficiently. I don't tend to try to build processes that are, terribly complex, that need a lot of my time and attention. And so if you're building that from the scratch or from the start, then you don't fill up your time and then have to, kind of work on it to make it more efficient. I just build it hopefully efficiently the first time. And that's mostly because I connect with people who have done it before, and I mimic their process, right? That type of thing. And so I haven't had to hire a VA yet, or some kind of, other partner, third party stuff too terribly much, which is helpful. Like, I use third parties in the way that they're intended for, for the operating kind of purposes, but not really for time saving. It's more for, expertise in their field. So it is kind of nice, when you're doing the financial analysis on like hiring a VA, they have to take things off your plate for things that you don't have time to do. And for me right now, I kind of do have that time to be able to even work on administrative things at this point. So I'm doing a lot of that myself because I don't want to hand it off to a VA when my alternative, what I'm doing in that time that I wouldn't be doing the administrative thing, isn't valuable, right? It would be personal time kind of stuff. And where that's nice, it's not income producing in a lot of ways, right?
Yeah. Or expense reduction. Yeah. If you're adding somebody some cost to it.
Exactly.
Okay. So let's talk about a deal now. So you kind of talked about it a minute ago, and I wanted to dive into like a specific deal. Maybe not the most recent, or it could be whichever one you want to talk about, but just kind of curious because, again, I know how you structured it. You were working, and so then you went out and you found capital partners to come in, right? And that's like a big strategy that you implemented so that you could focus on the actual property and being a lead sponsor just from the get-go. So can you talk about maybe one of the deals? Just pick one and just tell us how it came about, how you got the deal, how big it is, some of the specifics, just because for all the deal junkies out there, we all like to hear a deal.
So let's dive into my first deal. That was one of the more hairy deals. So it's fun to talk about this. So a little bit of backstory: about 6 months before I ended up buying this deal that we're going to talk about, I was under contract with a 132 unit that ended up having a fire after we had got into the contract period. We were doing our due diligence, and like 12 units burned down of 132. And sometimes that can be, not necessarily a negative. There's a lot of silver lining in a situation like that. But for me, since it was my first deal ever, the complication factor was too much for me, and I couldn't really do the trigonometry required, the financial, like all the movement that would happen when that happens in the middle of a acquisition. I said, hey, for my first deal, it's got to be a little bit more straightforward than this. So we ended up exiting that contract. But the reason I tell you that is that broker was like, hey man, I want to get you in a property. I feel bad about this. I mean, it wasn't his fault, of course, but he's like, I want to get you into a deal. And so we looked again for the next, 3 or 4 months real hard, and found the deal that I ended up buying. It's a 176 unit, and it's in kind of the central South San Antonio. Not really, I guess it's technically South San Antonio, but it's in a pretty nice pocket, I think. And it's it's an older asset. It's an 60s asset, late 60s, and Class C asset, nice working class community. And when I was going to buy that, the big thing that I learned through a lot of my education process and the mentorship programs that I'd been through is that you need partners, right? This isn't something you do alone. So I wouldn't have gone after 176 unit if I didn't have those that structure and those partners with me. And so that was one of the big things I did. I partnered with other partners who could bring investors to the table, amongst other things. and kind of help us all kind of get there. Guaranteeing the loan was a big part of this. We're having a $15 million loan. Are they going to give it to somebody with no credit or with no experience and a lower net worth? It's like, no, you need a higher net worth. You need some liquidity and you need some experience. So I partnered with somebody to bring that as well. And so you just kind of put all the pieces together, and the acquisition part of the process is really more like a project manager in a lot of ways. You might be the expert at like putting all those pieces together, but each piece is something that somebody else does better than you or better than me. And I was okay with that. That wasn't my role. So putting all those pieces together, we ended up buying the 176 unit. It was a $4.2 million capital raise. And so, myself and my partners all found our investors, brought them to the table, and we were able to raise all that in about a month, which was great. This was in December of 21 is when we actually closed. So one of the things that was tough about this was closing right at the end of the year. So we wanted to, there was a lot of people who were saying, hey, I need those, I need those K1 losses for that calendar year. So we wanted to place all that capital technically in 2021. So for those of you who don't know, the tax, incentives or bonuses that we get because we're doing real estate a lot of times, and you'll have to talk with your own CPA. I'm not a CPA, but talk with your CPA about how these deals can potentially, even though they're making money, have depreciated losses where your tax statement that we give to you says that, we depreciated the property faster than it made money, and you actually get a capital gains loss or a capital loss that can potentially offset a capital gain that you had somewhere else, right? So that helps us, be tax advantaged in that way. So we wanted to close in 21. Well, we ended up closing on I think it was December 28th or 29th or something of 21. It was crazy to try to get it in on time. We then bought the property and then started going through our bottom out period. So the property was in, after starting to operate it and go through it, we found that there, the financials and the reports that were coming out weren't quite as rosy as we had, been led to show what the property really was doing. So we ended up having to bottom out the property a lot more, which means, taking the tenants that were not, taking the tenants that didn't meet our tenant requirements, based on what kind of job or if they had a job, what their income levels were, that type of thing. A lot of the tenants weren't qualified to be or to have a lease at that level. So we ended up having to thin out some of the tenants and bring in newer, more qualified tenants into that space. And that took a pretty good dip. I mean, we were down to, I think in the high 60s or so.
Occupancy.
Thank you.
Yeah.
And so when you dip that low, cash flows are tough to come by. You're still having to operate the property at that high level, but your income is much reduced. So we bottomed out, came back up. Now we're in the 90s again. So we're stabilized after, I guess now. I mean, it took about a little less than a year to fully stabilize that property. And but now we have qualified tenants. We have cash flow coming in. We're renovating the property like crazy. So we're adding a lot of value to it. But at that time, that was tough to kind of go through that bottom out period. Yeah.
Did you have a big per unit CapEx that you were going in, and they were classic units, you were going to update them? Or was that not?
Yeah, exactly. So due to the investment is that we're taking a kind of a classic unit, something that, already exists. Maybe it's being rented. Let's say it's rented for $700 for easy math. And we go renovate the property. Maybe it's $5,000 to renovate the property and make it look better. And we can rent it for $900, right? So that $5,000 investment now, has a $200 a month premium on it. And you can, do the math and compound it out, and you're adding value to the property because your overall rents coming in are higher, your income is higher. And that's how these properties are evaluated. They're not like single family, right? Where it's more about comps and, hey, this is a 3-bedroom, 2-bath. This is a 3-bedroom, 2-bath on the same street. There's really no direct comparisons a lot of times for these apartments. You can't evaluate it like that. It's valuated more like a business, or valued more like a business, where it's based on the net operating income, and that you can really control a lot better than you can, like, hey, does this look like the property down the street? That doesn't really matter. It's more about the business and how the income is coming.
Yeah, it's the income approach on that. I was going to say, if you do the math on that, just that scenario, if you're investing $5,000 a door and you get a $200 rent increase on that, it's about a 50% ROI on those invested dollars. So, it's a pretty solid return on those invested dollars. And then, as you alluded to, you're increasing the NOI, and it's a multiple on the back end of the value that's actually created. So the reason I was asking that question, though, in this deal specifically, is because if you had planned on, I guess, renovating most of those units, if your occupancy dipped to 60, you just had 40% of the property, you're able to push those renovations a lot faster, I would imagine. So you're getting to your pro forma numbers a little bit faster.
Yeah, absolutely. So our limiting factor was capital at that point. So when you're renovating these properties, the way that these loans work, and we're in a bridge loan, which is a kind of a product that is like a private equity fund, and they will fund up a certain percent of the purchase price and do that up front, right? So it's similar to a house mortgage, where they're going to fund, say, 80% of the deal, and you have to come up with 20% of the down payment, right? Then they also fund your capital improvements. So if you assume, that you're going to spend, say, $1 million on improvements, they have that agreed upon that you can use up to $1 million and just add that money to your loan, whenever you need it. The problem is that the property has to do the renovation first and pay for it. And once it's all paid for, all the invoices are paid for, all the liens are released, then you go apply for that capital to come back to you. So you need some working capital to actually complete the renovation before you can get reimbursed for that money. So we're not talking about unlimited capital that we can just go renovate 40% of the property at any given time or during that year. That would have been really nice. We could have gotten a lot done. But the problem is, we had to have the capital to kind of cycle through and get reimbursed and do that, even when we were cash flow starved. So that was some financial juggling to make all that work. And then once we were able to kind of work through that process, then we're cycling through. So some months we were renovating, 3 or 4 units a month, which is a pretty high rate for 176 unit, which was nice. Normally we were looking at probably 2 or 3 in a month. So 3 or 4 is an aggressive pace. So that was great to be able to have. Anytime we had the capital to renovate a property, we would do it because we had it available. And now we're less so. Like, we don't have unlimited units available, but we're still being able to cycle them at a pretty good rate to keep that that trajectory, that momentum going. But that was a weird time to kind of go through. Certainly.
Yeah, man. I mean, that deal it's interesting. Again, and you're on bridge. I mean, we could talk about all that stuff. You mentioned cost seg as well. Just wanted to say, we discussed that at length on episode 20 with Yona Weiss. He's a cost seg king. So if you want to go back and listen to that episode and learn more about cost seg, it's a great place to get that information. And then we are getting close to the end, man. But I wanted to ask you, because this is a big thing. Again, you focused when you got in, you focused on building the relationship side of capital partners coming into your deals, so that you could focus on underwriting and finding and acquiring, right, contract and get them locked up. So what is the conversation like with a potential capital partner who's going to come into you? Like, how do you source them? And then 2, like, what's in it for them, and why would they want to come into a deal like that with you?
Yeah. And also a little side note, we worked with Yona Weiss and Madison Spec on these last couple of properties. So good vendors to work with. And he's good at explaining the process, what it all is. But anyway, so one of the big things is the capital. They're not just capital partners, right? That's the main thing. You've got to come in and be a part of the project, right? These aren't securities brokers, kind of people that are like what do they call financial analysts, kind of, or financial
like capital
planner.
allocator. They're not just putting money to work.
Type of person. They're really a true partner on the deal, right? That's the biggest thing. Is they understand the deal, they've walked the deal, they've maybe gone through due diligence, and so when you're trying to find somebody to work with, you need somebody that isn't just gonna. They're not just a paycheck. They're not just a checkbook. They're really part of the process, right? And so they can bring some experience, things like that. I meet these people all over the place. So a lot of times it's through conferences or masterminds that I'm a part of, or relationships that I've fostered. That's it's hard to just meet somebody off of LinkedIn or something and say, hey, this is what you do, right? You need to have a strong relationship with them, because you're getting into a deal with them. You're sharing equity. You have a lot of trust there that you've got to build for this project. So it's really important that you can work with them on a long-term basis, and that you like to work with them. They like to work with you. You have shared principles, shared values. And that they can also offer more than just, hey, I've got some investors, right? They need to be more substantively part of the deal as well. And that's an SEC thing as well.
Yeah, for sure. Yeah. Awesome. Well, Kenneth, man, I love the info, and I love what you're doing. Congrats again on quitting the W-2, having free time to do some more dishes, hanging out with the family.
Absolutely.
Before we go, look, I ask sometimes I don't, but I'm just kind of curious. Let the listeners let us all get to know Kenneth a little bit better. Like, what's your favorite pastime? I heard you mention hit some golf balls. You and I need to go play some golf, apparently. What else do you like getting into?
Yeah. And I hadn't picked up a club in like 5 years. So it's been nice to get back into it a little bit. And I've, got a coach to kind of get me back in the motion. So that's been nice. In the past, I kind of collect hobbies. I'm into woodworking. I was a sailor back in college, so I still like to go on the water a little bit and go sailing. But right now with 2 young kids, I've got a 3-year-old and a 5-year-old. That takes up most of my free time. We have the same age. That's great. Yep. So on that point, what's the best thing that's happened to your family in the last, month or two? Favorite memory? So I just built a new play structure for them last week. So I went to Costco and got one of those, those build it yourself kits. Yeah. And so they've been really enjoying that. But that's awesome. Yeah, my eldest is about to get into kindergarten. So kind of crazy times. Yep. Yeah, man. Yeah. Kellen just finished his first year. So yeah, it's a big move, and it's great to see that their faces light up when they're like, I'm a big kid, I'm going to school. So yeah, awesome. Cool. All right, man. Well, hey, it was good catching up. Thanks for sharing your knowledge, your experience, your information. If anybody wants to reach out to Kenneth directly, his info is going to be in the show notes, and we're going to catch you guys on the next episode. Bye-bye. Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.